Okay, good day to everyone. By the time this video is out, it should be the weekend. We're going to come up with something really fun this weekend, and I'm going to talk about this really memeable statement, okay, called dividends investing is dangerous. Okay, all right. And the background is this is a very highly viral statement that likely originated in the 1M65 Telegram discussion groups. Uh, Somehow, the statement offended some of the denizens of the dividends investing groups, and it led seasoned investors to talk about how dangerous their behavior is when they receive dividends into their bank account. Okay, and as far as I'm concerned, this statement has brought a lot of fun to people who observe what's happening within the forums like myself. Okay, but I think that it is time for us to stay calm and in a respectful manner. Let's take a serious look at this statement and see whether to what extent is this true, to what extent it is false. All right. Okay. So right from the start, I'd like to talk a little bit about whether dividends work in the investing world. And there's actually plenty of data, plenty of investment literature that talks about the power of dividends investing. In this example, I have a 46-year record of how effective a dividend strategy is. And interestingly, it includes Singapore in the mix. You find that in Singapore, if you've chosen high dividend yield counters, right, your returns, your 20-year compound annual growth rate is about 9.7%, which is quite fun, quite good. And if you invest in low dividend counters, you only get 3%. Okay, and if you look for companies that don't pay a dividend, you're seriously disadvantaging yourself at 2%. Okay, and even if you look at the worst 20-year CAGR, right, dividend stocks lost 0.6%. Okay, and companies that don't give a dividend dropped 17.7%, which is an absolute disaster. And you can observe the rest of the markets that I've shared with you. Okay, interestingly, the data doesn't include the US, so we're going to do a little bit of number crunching to figure out the what we are looking at when we look at the Standards and Poor 500. Okay, if you're interested in this table, you can look for a book called 10 Ways to Invest, Contrasting Investment Ideologies in Practice by Tariq Dennison. Okay, and the strength and the evidence of the effectiveness for dividends investing around the world simply cannot be denied. All right, whatever slogan, whatever meme you come up with in your group, yeah, I don't think that there is, I don't think you can deny the power of dividends investing. Okay, all right. Now, before I actually move on with other quantitative data, right, a lot of the power of dividends come from its ability to provide emotional support. Okay, the dividends investors, such as those in the various forums, they have a religious fanaticism towards their investing style, as many of them, including myself, we've basically been paid dividends for the past, more than 2 decades, right? More than 2 decades. Over time, these regular payouts reinforce our resilience and it improves our ability to hold on to our investments during a downturn, right? And this is very familiar to people who play REITs. REITs have done very badly. In fact, if you had bought REITs that gave the highest dividends, they have done very, very badly for the past 3 to 4 years. And so when we provide investment courses, we are very familiar with that. And we come up with ways to teach our students how to avoid that problem when a particular factor were to underperform for many years, all right? So yeah, but a lot of us are stubbornly holding on, okay? But that's because we've been paid for many years, right? We've been paid during a downturn, during the pandemic, during the Great Recession, okay? Right. And therefore, because we are able to hold these investments through a drawdown period, we are also able to emerge from a recession and benefit from the upswing, right? And so we benefit from market recoveries more than many other growth investors who might have a higher return on a back test, but may not have that mental willpower and fortitude to hold on to their investments over time. All right. And so no other form of investing can emerge, right, as a form of mental wellness. And so when I speak in public to members of the public, even though I'm extremely quantitative, right, what is really powerful and impactful about investing in dividends is that it is actually a form of mental wellness, right? It can fend off a toxic workplace, magically improve your mood, all right, especially for men, okay, make you more confident as a date, okay, right. Okay, so let's deal with the elephant in the room. Okay, what about the US? All right, and to actually do a proper apples to apples comparison, and you can say that maybe it's not an apples to apples comparison. I have taken on the left hand side the 10-year returns for the Standards and Poor ETF. On the right hand side, I needed to find some kind of proxy for the dividends investment ETF, and the closest one I found is the Schwab US Dividend Equity ETF that sort of picks 100 stocks with the highest dividends. Okay, and so that will give us a good comparison with the Standards and Poor, and let's see what our findings are. So if you observe the returns, we find that actually it's true. Dividends have underperformed returns-wise. Okay, so if you were to buy the Standards and Poor, and this is a very tech-driven kind of market, right, the US, in that there is a substantial improvement in returns if you simply include the tech stocks rather than exclude a tech stock, right? Which is why dividends actually underperform. But dividends do arrive with a much lower risk, all right? Standard deviation of 20 versus standard deviation of 21, right? The skew, the kurtosis, right? The Sharpe ratio is obviously lower for dividend stocks, okay? And so I would say that I think over the past 10 years, the winner would be the Standards and Poor 500 and the sheer volume of technology stocks inside, okay? So on top of it, if you invest in dividends in the US, that's actually not very good because you pay 30% withholding taxes as well. So you're penalized again. Okay, so clearly the US is a more growth-oriented market, and this is the closest thing that I can find that justifies the idea that dividends investing is dangerous. Okay, all right. So we've done dividends, and what about China? And Chinese dividend ETF, at least I couldn't find one that could get the data that I want. So I've decided to find something within Hong Kong to actually compare the numbers. All right, so we have the Hang Seng Core ETF 3115, and we've got a Global X Hang Seng High Dividend Yield ETF 3110. So I put them side by side so that you can perform a comparison. So in the case of Hong Kong and other markets, dividends do dominate. Okay, in fact, dividends dominate by quite a bit. 5% improvement in returns over the past 10 years, and only 80% of the risk, right? The standard deviation is 26 for the Hang Seng, but the high dividend yield, it's only 20%. Okay, if you look at the maximum drawdown, if you were to just buy the Hang Seng Core ETF, the drawdown is as high as negative 50%, but dividend stocks would have preserved your wealth, right? If you end up mistiming your buys. So for the past decade, a dividend tilt in Hong Kong has yielded higher returns with a lower risk, all right? And so naturally, even the Hong Kong stock market favors dividend yields. And what about Singapore, right? In Singapore, there are no ETFs for us to compare, but fortunately, I do a little bit of back testing on some of the tools I cover in the early retirement masterclass. So from the 5th of June 2015 to the 5th of June 2025, if you had invested in the top 40 largest market cap companies in Singapore, your return would have been about 4.19%. If you invested in half that subset of companies with the highest dividends, then your return will be improved at 7.28%, right? At a lower risk as well. So this is very consistent with our results in Hong Kong. And it makes sense, right? It makes sense because our popular stocks in Hong Kong have always been these high-yielding banks, real estate investment trusts. All right. So what does the numbers clearly show? Okay, dividends investing is associated with lower volatility across markets examined. Okay, dividends as a factor does not consistently result in higher returns, especially in a market like US, where you tax your dividends and capital gains differently, okay, for investors. In the US, returns from a dividend portfolio is objectively lower, and comes across as being less volatile. So finally, the question of whether dividends investing is dangerous, it turns on what is your definition of dangerous. All right, if dangerous means low returns, then I would say that the statement that dividends investing is dangerous is valid for a very few select growth markets, right? Maybe just the US. Okay. But if dangerous means high risk, then the statement is almost false, right? For most markets. And I would say that even if we use professional measurements like value at risk used in middle offices in a bank, I would say that the statement that dividends investing is dangerous continues to be false in most markets. All right. All right, but with due respect to 1M65, their community, and their founder, Mr. Lu, I still think that they have done a great job, right? Making dividends investing popular. Okay, and I think the thing about dividends investors is that for me especially, I actually enjoy it when people criticize our investment style, you make fun of it, right? But the fact of the matter is that I've been made fun of, even by fellow Dr. Wealth trainers, because of my stubborn insistence on dividend stocks in Singapore, and it's a cross that I enjoy bearing. Okay, I think within the right context, dividends investing can still be dangerous. Okay, they're dangerous to your employer because if you know how to get dividends from your investment portfolio, you will no longer being held down by golden handcuffs. You're the most dangerous guy in the office, right? You can quit anytime. You can burn all your bridges. You can even put in some time to destroy a very bad manager, right? If you can live on your dividends, this is the kind of power a good dividend portfolio can be put in your hands, right? Do your colleagues a favor, maybe get rid of a supervisor, give her a bad rating, right? Do your colleagues a favor, all right, before you leave. Okay, there's always something that I want to encourage dividend investors to do, right? We can raise the overall standard of managers in Singapore, right? Yeah, and hopefully that person will be replaced by AI sooner than we think. Now, dividends can also be dangerous because you follow the advice of the folks in the dividends investing Telegram groups. They love taking photos of the dim sum and the food that they buy. Okay, and that's detrimental to their cholesterol levels of blood sugar. Okay, all right. So that concludes our discussion on the statement of dividends investing is dangerous. Okay, be nice to the various forum groups when you're sharing this video. I created this video hopefully in the spirit of respect for both the dividends investing Telegram group as well as 1M65. The quality of the discussions has gotten better and better over the years. I congratulate the people who administer these Telegram groups. Okay, with that, if you like my content, subscribe to my channel. You can buy me a coffee on this link. If you want to listen to my life story, figure out how the financial independence and retire early works, then come for my course preview. Google ERM intro. Take the first link. And with that, thank you very much. And I'll see you next week.